Credit risk and funds transfer pricing, FTP, what you need to know. When it comes to managing financial institutions, two key concepts that play a crucial role are credit risk and funds transfer pricing, FTP. In this video, we will explore what these concepts mean and why they are important in the banking industry. Understanding credit risk. Credit risk refers to the potential risk of loss that a lender may incur if a borrower fails to repay a loan or meet their financial obligations. It is a critical aspect of banking, as it directly affects a bank's profitability and stability. Banks assess credit risk through a process known as credit analysis. This involves analyzing a borrower's creditworthiness, including their financial history, income, and collateral, among other factors. Through credit analysis, banks determine the likelihood of a borrower defaulting on their loan and set appropriate interest rates and terms accordingly. Importance of credit risk management. Effective credit risk management is vital for banks to maintain a healthy loan portfolio and mitigate potential losses. By accurately assessing and managing credit risk, banks can minimize the chances of bad loans and defaults. This, in turn, helps protect the bank's capital and profitability. To manage credit risk, banks implement various strategies, such as establishing risk appetite guidelines, conducting regular credit reviews, and diversifying loan portfolios. Additionally, banks use credit risk models and stress testing to estimate potential losses during adverse economic conditions, enabling them to make informed risk management decisions. Funds transfer pricing, FTP. Funds transfer pricing, often abbreviated as FTP, is an internal process used by banks to allocate costs and revenues to different business units and product lines. It is an essential tool for assessing the profitability and performance of various activities within a bank. FTP operates by assigning a value to funds transferred between different departments within a bank. This value includes the cost of acquiring funds by the bank and the pricing for lending those funds to borrowers. By accurately measuring the cost of funds and assigning them to the respective business units, FTP helps banks determine the profitability of its lending and borrowing activities. Importance of funds transfer pricing. FTP serves several purposes within a bank. Firstly, it helps banks evaluate the profitability of individual products, services, and business units. By identifying the costs associated with different activities, banks can allocate resources effectively and make informed decisions on product pricing and resource allocation. Furthermore, FTP serves as a strategic tool for banks to incentivize profitable behavior. By linking performance measures and compensation to FTP results, banks can encourage employees to focus on activities that contribute positively to the bank's profitability. Conclusion. Credit risk and funds transfer pricing are key concepts in the world of banking. While credit risk management ensures the stability and profitability of a bank's loan portfolio, funds transfer pricing helps evaluate the profitability of different business units and encourages strategic decision-making. Understanding these concepts and implementing effective strategies in credit risk management and funds transfer pricing is vital for banks to thrive in a competitive financial landscape. Want to learn more? Claire Trithel on LinkedIn.